This is the Rocket City Retirement Show with Chris Wallace. Chris loves educating people in person and over the airwaves. Whether it's retirement planning, investing, tax, or legacy, Chris prides himself in helping protect what matters to you. This is the Rocket City Retirement Show.
Hi, welcome to the Rocket City Retirement Show. I am Luann Fulmer here with Chris Wallace, certified financial planner and financial advisor at WG Financial Group. Of course, he's president as well. I'm not sure that I mentioned that, but he is the guy there at WG Financial Group. I want to make sure that we give you this phone number, 256-937-2010. That's the way to reach out to Chris, because you can get a complimentary appointment with him. We call it a discovery visit. Call the number, or if you like to text, you can text as well. Text the word visit to this number, 256-937-2010. And Chris would love to meet with you and guide you on any questions you might have about retirement. Of course, that's what we talk about on our show is all, the ins and outs of retirement. You can also check out Chris's Facebook page. It's at WG Financial Group 256. Anything pertaining to the show that happens after this show, he'll have comments on the Facebook there. And that's pretty cool. He can stays up to date with all the news headlines, things like that. Remember, our motto is plan, retire, play. We want that for you. We want you to be able to retire and play, but you have to do some planning, ahead of things. And that's what Chris is all about. WGFinancialGroup.com. That's the website. And remember, our show is available on Spotify and Apple Podcasts. Just search for the Rocket City Retirement Show. Chris, so excited to be here with you.
Yeah, it's great to be here with you as well, Luann. It's been kind of hit or miss the past few weeks.
Yeah, it's been, I feel like this has been a very busy time of year, really.
It has. I mean, not from the standpoint that I'm working, 75 hours a week or anything like that. It's just, training and different things that I've had to do. And it's kind of fallen on days that we record together. Yeah. And then we've had to do some reruns for tech reasons. I think we had 1 week where we recorded and then found out that the recorder messed up.
It was crazy. Like, I'm still worried, like, what did I do? Because all of a sudden 10 minutes of our show was gone. And I'm like, what? I've never had that happen before. Ever, ever, ever. So, yeah that was terrible.
Right. And I know that we fixed that. The following week, I went and just recorded the last 10 minutes over again, something like that.
You had to redo. You had to redo what you.
Yeah. So fortunately, I keep little notes that I write down, and I didn't throw them away after the show that week.
Thankfully.
Thankfully. So I was able to come back in and kind of do that. But here's kind of the thing. I could actually tell when the transition took place.
No way.
I don't think the listener. I listen all the time.
I don't think people knew.
No, I don't think so. But I could tell where they spliced in that 10 minutes because
that's funny.
They basically stopped recording. So it's good to be back. I'm glad to, do another show this week. And I want to get into a little bit of a market update and talk about the S&P right now. This is as of 10/21. The S&P's up 23% on the year. The Dow's up 14.8, and the Nasdaq's up 23.2, and the aggregate bond index is up 2.9%. So again, all major indices are positive, so that's good. But one strange thing that's kind of happening here as of late is the 10-year yield is actually rising again. So the 10-year yield took a strong dip in anticipation of Fed rate cuts. Rate cuts happened. Mortgage rates were dropping. Now all of a sudden the 10-year yield is going back up, and we see mortgage rates going back up. And it's almost like the 10-year yield thinks, and I'm kind of, this is gospel according to Chris, as I like to say. It's almost like the 10-year yield is reversing course a little bit, maybe because it thinks the Feds may have been a little aggressive and a little bit too early on the cuts. And maybe pricing in there could be some inflationary stuff kind of reoccurring, if you will. And so this could be the markets kind of repricing some of that in. And I do like to say, this is something I've said for quite a while, is that people tend to overreact. So I think we as humans, depending on the circumstance, especially when it comes to the markets, we overreact. And sometimes when you think about the markets in general, they tend to overcorrect. So we overreact, markets overcorrect. And this could just be a repricing in of what the market believes that the Feds are actually going to do. So enough about the markets. The IRS released their new tax brackets for 2025 today. So that information is available online. I may post a link out on Facebook if you just want to go there and check it out. Nothing changed in terms of the marginal brackets, but what we saw was the amounts are different. So just to give you an idea here, the top of the 10% tax bracket is $23,850 for married filing jointly. And the top of the 12% bracket is $96,950. And really the top of the 22, which is an important bracket because that's right around your IRMA limits, that's $206,700. So again, the IRS released those. They also released new capital gains brackets. So just as a reminder, the capital gains bracket, long-term capital gains brackets are 0, 15, and 20. And the top of the 0 bracket for taxable income to stay in that 0 bracket for 0 capital gains, which is a great place to be, especially if you have non-qualified positions that have long-term gains early in retirement. There's a potential you can take some of those gains out at a 0% rate. The top of that bracket is $96,700. And the next important one for a multitude of reasons is the top of the 15% capital gains bracket, and that's $600,050. And so those are important numbers to know. Wow. And then the standard deduction actually is increasing to $30,000 for married filing jointly. Again, if you're single, just cut it in half. Last year this year rather, it's $29,200. So, a slight increase there, really for adjusting for inflation. And when I want to go back to capital gains for a quick second. Okay. So we were talking about the marginal rates, which are the 10, the 12, 22, 24, 32, 35, and 37. Those are your marginal tax rates. We talked about the cap gains rates. But then there's something called net investment income tax. And that's something that I feel like a lot of people don't know about. So I'm going to talk a little bit about it. I think I may have touched on it in a previous show, but I'm going to go there again just to kind of help people understand that, there's just a lot going on, especially when you're working and you're really not sure how things are taxed and some of the things and the way that they're written within the tax code and how they work. I think it's important to know that because it may sway your decision on whether or not to work with an advisor. It may sway your decision on whether or not to work with a CPA. It may also just make you rethink how you're investing in non-retirement accounts. Okay, so let's kind of talk through this. So when it comes to net investment income tax, a lot of people call it NIT or NIIT. And some people just say NIT, the NIT tax, and it's 3.8%. So if you are married filing jointly, if you have a modified adjusted gross income of $250,000 or more, you're going to pay 3.8% on income or interest. And I'll go through a couple of examples here in a second. You're going to pay an additional 3.8% on that. If you're single, it starts at $200,000. So as a single person, you actually get a little bit more room there. And if you're married filing separately, which is I won't say it's super rare, but it's more rare. Most of the time you're going to file married filing joint or you're going to file single. If you're married filing separately, the NIT tax actually starts at $129,000. So what are some examples of the income that's taxed at an additional 3.8%? So that would be long and short-term capital gains. That would be dividends, taxable interest. So let's think about the savings accounts rates that we're seeing today. Mm-hmm. So a lot of people have a lot of money in savings, or they have them in money market mutual funds that are paying anywhere from 4 to 5%. Well, if you're making or have a modified adjusted gross income, again, as a married couple, of more than $250,000, that interest that you're earning, in the bank account or the money market mutual fund that's not in an IRA, it's not yielding. Your net yield is not what you think it is, because the interest that you're earning on that, the interest itself is taxed at ordinary income tax rates. But if you have that modified adjusted gross income of more than 250, there's that extra 3.8% tax on the overage over and above 250. If you have rental property or royalty income, it also sees the NIT tax of 3.8. Again, anything in excess of 250,000. So you have to think about that when you're investing. This is something that we're conscious of at the office when we're working with a family and trying to help them figure out, well, how should I be invested? And so a lot of times I hear, Chris, I've been reading, because I hear, or I've been looking online, or I've been watching YouTube, or I talk to my neighbor or somebody at work, and They say, dividend stocks are safe. And maybe I want to do some dividend stocks. And the first thing I think about is when I hear the word safe, just me personally, when Chris hears the word safe, it means that the investment is not going to lose, or it's going to lose very little. Mm-hmm. So when somebody says to me a dividend stock is safe, I'm like, nah, it's really not. Because you could think of a dividend stock like the Dow index, and just go do your own homework here and look it up, what happened to the Dow during the Great Recession. Both the S&P and the Dow were down pretty much the same at one point. They were down pretty much the same. So when you're telling me a dividend stock is safe, that I'm not buying that, because in someone's mind, that's what they're also thinking. That's the reason they're saying that. I say, "Whoa, Chris, they're high quality blue chip stocks." All of that's true, but they're still a stock, and they're still going to see downward volatility. And they say, "Well, it pays a dividend." Okay, great, it pays a dividend. Sure, I'll give you that. But when I say that, when I hear that it's safe, I don't see it as safe. I see it as a company that maybe has been around for a while, a more older established company, and maybe it pays a dividend. So take, for example, if you have this modified adjusted gross income of more than $250,000, because there's a lot of people in the Huntsville area. I know a lot of our clientele, while they're working, are making over $250,000, especially if both of them are working. And let's just say they have an after-tax brokerage account, a non-IRA account, a non-qualified account is what we call it in the industry. And let's just say they have, I don't know, $500,000 of dividend stocks just kicking off, 3-4% dividends. That's a substantial amount of money, the dividend itself, that's going to be taxed at a 15% capital gains rate, because the dividend, you're taxed in the year that it's distributed. So you got a 15% tax there. And because your modified adjusted gross income is more than $250,000, you're also seeing the NIT of 3.8 on the overage over and above $250,000. So essentially, your dividends are getting taxed at an 18.8% rate if you look at it that way.
Yeah.
So I'm of the mindset, when I'm dealing with a non-qualified account, I'd almost rather have positions in the non-qualified account that are really geared more towards either A, municipal bond interest, so that becomes tax-free, or I would be looking at stock positions that maybe did a lower dividend. So I'm not getting all of that excess income that I really don't need. But in people's heads, in investors' heads, they think dividend stocks are safe. So, hey, I'll go with dividend stocks. Meanwhile, that portfolio that I just kind of hypothetically mentioned there is kicking off a lot of income that you don't really need, but you're paying the tax on it. And sure, the dividends go back in, but you're still raising your current tax bracket. So I say all that to say this is, again, kind of what we're looking at the office when we're sitting down with a client. Maybe they're a higher net worth and they have some of these situations going on. And when I say higher net worth, we don't specify limits with people. I don't have minimums and limits. So I just kind of want to make that clear. But in this example, these would be kind of higher net worth individuals that may have these types of situations happening. We're taking a look at that and we're saying, hey, did you know that you're hitting the NIT limits, and what can we do to reduce tax there? The other thing that I want to note here is if you're not buying individual dividend stocks, because remember, you won't pay the capital gains on the stock itself until you sell the stock, but you will pay it on the dividend. However, when you own a mutual fund, let's just say you own an actively managed mutual fund in a non-IRA taxable account, a non-qualified account. Let's say you buy these mutual funds and you have them, and you're building up a portfolio of mutual funds because maybe you don't want to pick individual stocks, and I completely understand and get that. So you buy these mutual funds. Well, one of the negatives to holding an actively managed or a mutual fund in general inside of a non-qualified account, especially if it's a stock one, the possibility of getting what is called like phantom capital gains is a reality for you. And that happened a lot between 2021 and 2022. And what that is where the mutual fund manager will sell off positions within the fund. And some people listening to this, they'll understand. They'll say, oh yeah, I got a 1099 back in 2021 because of this. The mutual fund manager may decide to sell off some positions. You didn't do anything. You still own fund XYZ. You didn't do a thing. You didn't sell that fund, but the manager inside the fund sold that, and it caused you a capital gain. And again, so there are people today listening that had that happen. And they're like, man, we paid a lot in taxes that year because of capital gains. Well, it wasn't because you got this enormous amount of dividends. It was likely due to what I call the phantom gains inside of mutual funds. And that's why when we're setting up portfolios for individuals and families, we're doing that with individual stocks, or we're doing that with ETFs, low cost ETFs, because ETFs don't have that situation. And then also with a stock, you don't have that situation either. It's really only kind of only happens with mutual funds. So you have to be careful with all of this. And, I again, bring all this up, Luann, because there's just so much that goes into retirement planning. The investments are just part of it. Okay. And just what I've mentioned here, taxes and capital gains and NIT and mutual funds in a non-IRA type account, kicking off income, causing additional taxes inside on your tax return. There's a lot of moving parts here. And that's why I like to say that I don't think retirement planning is like a puzzle, because you can kind of solve a puzzle. It's more like a Rubik's Cube. Mm-hmm. And again, I don't own the rights to the Rubik's Cube. That's its own trademark entity. But when I'm doing a Rubik's Cube, and they're all over my office, when I'm doing a Rubik's Cube and I'm turning that Rubik's Cube and I'm looking at the yellow side, I'm doing something probably to the red or the green or the blue side that I really can't see. Now, I'm not one of these guys that can solve that thing out in about 3.5 seconds. But, in reality, when I'm cranking on that Rubik's Cube, there are things happening on the other side of the cube I can't see. And a lot of times when it comes to building retirement plans, and if you're trying to do this on your own, sometimes you're doing things that you don't really know that you're doing to yourself, because you just think it looks right, it feels right. And, all of a sudden you get the 1099s in the mail, and now you're having to add all that to your tax return. I received a phone call from an individual that watches our TV show, actually, and he set an appointment to do a consultation with me, and he basically just had a question. Now, we typically just don't take phone calls and do just one-off questions, but this individual was very worried, and he was getting ready to sell a house, and he's all freaking out about selling the house that he lives in. And so when you're single or married and you've lived in your residence for the last 2 out of 5 years, you get a capital gains exclusion. So here this guy was just freaking out about selling his resident property that he lives in, and he's actually not going to have to pay any capital gains. But he was concerned. And the reason he was concerned is because he's 71. He's really close to having to take RMDs, and he was also concerned about the IRMA limits. So, again, trying to do some of this stuff yourself, there's just a lot. And that's where, we come into play, Luann. I mean, we've been doing this show now for, 8 years at this point.
Starting 9.
And yeah, so 16, right? So it's been a long, long time. And there's just a lot that goes on with retirement planning. So I know you want to give our number out, but I've got a little bit more I want to get into real quick. I actually found an article I found kind of funny. So I'll cover that here in just a second. And then we'll kind of move into, the meat of the show, if you will.
Okay. So yeah, let's get that number out. You can do the same thing. Call like this guy that was watching our television show, 256-937-2010. That's the number to call. If you prefer texting, text the word visit to that number, and you can set up an appointment that way. You'll just, get the bounce back, and you can do it all via text. Either way is possible. We've made it possible for you. If you call, you'll hear Chris's warm and friendly voice, and then he will call you back, and you guys can set up that appointment. So we're so excited that you're joining us today. So happy to have you with us. This is the Rocket City Retirement Show. I want to give you our website too. Great information there. WGFinancialGroup.com, name of the company, WGFinancialGroup.com. And thank you so much for joining us. This is the Rocket City Retirement Show. All right, Chris. Yeah. Okay. Tell us the funny thing you wanted to share first.
All right, I'll get to it in just a quick second.
Okay.
We mentioned the TV show, right? So there are probably some listeners that don't watch TV, and I don't watch a lot of TV, to be honest with you. As a matter of fact, I fell asleep the past week while we were trying to watch Netflix, and we were watching a show, and I think I fell asleep like every episode. Jen had to kind of like update me when we were done watching the show, because I just drift off at night. But about the TV show, it's Rocket City Retirement Show, just like the radio show. Yeah. So if you have like YouTube TV, or you're using a streaming service, you can actually search the TV show, Rocket City Retirement Show, and actually put it in your hopper to record. So you can then go back and watch it at different times. Now, I do deep dives in topics like we do here on the TV show. You get to actually kind of see us. It's just a different way to kind of connect and kind of watch what we do. So again, if you're some of the shows come on early, set your record, put them in your record hopper so it goes out and records all the shows for you, and then you can just watch them and maybe you'll fall asleep. Maybe, talking about financial information will put you to sleep. I know some people it probably will. But if you want to do that, you can definitely do that. A couple more things on the update of the tax code real quick. As I was talking about the IRS releasing all the new brackets, the estate tax exclusion is now moved up to 13,990,000. So 13,990,000. Luann, I don't know about you, but I'm not at that limit. Probably will never be at that limit. But it's there for the high net worth earners.
Wow.
And then you also can have portability. So when you look at it from a portability perspective, you're looking at nearly today, where it stands today now. It will revert back at the end of next year if nothing's done with the tax code. But that's nearly 28 million of exclusion there for a married couple if you're using that portability option there. And then one that I always get asked about, I just thought I would touch on this real quick. The annual exclusion for gifts is actually moving up to 19,000. It's currently at 18,000. So a lot of people say, I know that you can give away like 14 or 15,000, and they're on the right path. They're talking about the amount of money that you can gift away without really having to file any gift tax paperwork. And that's actually moving up to 19,000, and it's a per person. So let's say that you were going to give it to your son and then his wife, your daughter-in-law, then you would be able to gift away, $38,000 that way, because you can do it as per person. So just important to know there. Okay, now to the article that I saw this on X. So I'm on X, and I like to read stuff on my Minnesota Vikings, who sadly lost this weekend, their first game of the season. Hey, but we're 5-1, so I'm so happy about that. Okay. And my good friend was over at the house, probably my best friend locally, was over at the house. He's a Detroit Lions fan, so he was happy. I wasn't very happy, but having him there really held me accountable for my behavior. So there was no throwing of objects and, no nasty stuff coming out of my mouth because Minnesota lost. So we're 5-1, so still happy about that. Yeah. But anyway, just kind of want to move into what I saw on X. And so I do follow some financial stuff. And one of the articles that I saw, and it made me think, because Jennifer and I have had this discussion before, and maybe you've thought about this too, Luann. So I would encourage you to have some, back and forth conversation here. But when does remote work end? And that's something we've come out of COVID. We were all kind of on lockdown. Many of us were remote working. I mean, we were back in the office pretty quick. Okay. But there's still corporations today that are allowing employees to work from home.
Oh, a bunch of them. I mean, our company does,
Yeah. So at what point do where does that finally end? And I'm not advocating. So people that are remote working, I'm not saying, hey, I'm telling on you, that sort of thing. I'm just kind of wondering at what point do corporations.
I don't think it does. I think it's a new norm.
Well, yeah, I kind of do, but there's some data coming out, and I want to get into that. Okay. So it's an article from the USA Today, so not my favorite newspaper, but it has some, information I thought was kind of interesting. So one of the things that I've always talked to my wife about is there are people, and this is helping the economy, by the way, because most people are working. There's more people today working multiple jobs than there really ever has been. Yeah. So this is from the article. 26% of millennials admit to taking a nap during the workday. I hope your boss don't hear this. Right. 26% of millennials admit to taking a nap during the day compared to 16% of Gen X. Yeah. And I can promise you I'm a Gen Xer. I ain't in that group. Yeah. I'm not in the 16%. I'm in the 0%. I don't have time to take a nap. No. 18% of Gen Z has worked another job compared to 2% of Gen X and 1% of boomers.
So they're working more than one job.
While they're working.
Oh, what? Oh.
18% of Gen Z have worked another job compared to 2% of Gen X, 1% of boomers. And get this, 31%. This is okay. I mean, if you're remote work, you're remote work. It is what it is. 31% of Gen Z have worked from another location without telling anyone, compared to 16% of Gen X. So,
what do you mean another location? Well,
maybe they're on vacation.
Oh, and they don't tell them they're on vacation.
No,
Okay,
they're just
gotcha.
working remotely from the beach. And again, if you're remote work and you're getting your job done, hey, all for it.
Yeah.
But seeing these articles, just for me as a owner of a company and just a hard worker myself, my whole life, I just have to wonder when are corporations going to say, all right, you all have to come back to the office.
Enough is enough. Yeah.
Yeah. And we've seen companies do that, right? I mean, we've seen a lot of companies in the past couple of years now are calling people back to work. Apple, I think Google, Amazon, some of the tech companies are bringing people back in. But I have clients right now, and I have prospects that I met with who are still working because they're remote work, and maybe they're home 5 days a week, maybe it's 3 or maybe it's 4, but they're mostly or fully remote. And the common response that I hear, and I don't blame them. If this were me, I would be the same way. They're like, why would I retire? I wake up and go to my home office and I start working and I'm done. I don't have to drive and I save on gas and all of that. And mind you, that the people that I have met with, they're in that 0 category like me. They're working, remote and all that.
Yes,
they're working hard, but that's why they're still working. They're in what I call their peak earning years, and they're still working from home. So why do I retire? Right. Especially like if you're a federal employee or you're an employee who gets a pension, you're like, okay, I'm just building extra time that goes towards my pension.
Yeah.
So why would I stop? So anyway, I just saw the article.
That's interesting.
I thought it was really interesting. But hey, listen, it's most of the stuff that's in there. I'm surprised it's as low as it is. The percentages of people that have taken a nap at work. or working from another location without telling their employer.
Oh my gosh.
I'm really surprised that the numbers are as low as it is. And maybe they're higher and they're just kind of too afraid to say that they're doing it. Yeah. So I just found that really wild too. And I just wanted to talk about it just because I've talked about it with Jen before at home. And it's like, okay, when does this actually end?
I don't think it's going to. Now, I will say Bobby and I have talked about going somewhere in the winter. Now my job's a little different than his job, and then he would work, I'd be out having to take a vacation, but where he could work somewhere like wherever, Arizona, someplace warm, and work for about a month. And then maybe I would work a little, I don't know, but I could do my radio shows. We do it like we do. So I guess I could, we'd have to set it up that way. But yeah, we've talked about that too, like in the winter, So.
Yeah. And I'm not saying you're a bad person or I'm not blaming anybody. Do it while you can. I would be taking full advantage of it if, if I were in that boat. I mean, there are days where I do a little remote work myself. But it's just going to be kind of wild to see which companies over time end up saying. And now people have these adjusted lifestyles, so they don't want to go back. And
no, they don't.
So how will that impact the economy? Like if this many people are working multiple jobs because they can, because they're remote working.
I can't believe the multiple jobs though, Chris. That cracks me up.
Oh yeah,
I'm on the clock.
I knew that was going on.
Oh really? I'm on the clock here, yet I'm doing something over here for them. Oh dear.
Yeah, or you just have more time because you're not commuting to work and stuff. Well, that's
true, yeah.
And then maybe you're working 2 remote jobs at the same time.
Yeah, 2
that's happening. That kind of stuff happens. So anyway, this is kind of halfway through the show. So if you're catching it on a Sunday morning, you're catching the 30-minute version. If you want to go back out to Spotify or Apple Podcast, you can listen to the entire show. But it is time to get us off to a little bit of a break. And then we're going to come back and we're going to get into some interest rate talk and IRAs and rollovers and things of that nature. So again, that'll be the second half of the show. Hope everybody's enjoying it so far. Our number, if you'd like to set up a discovery session, it's 256-937-2010. Again, our number is 256-937-2010. I don't have free stuff to give away. I don't have gimmicks. We don't do stuff like that. But if you want to set up a discovery session and lay out your retirement plan, go over those dreams that you have so that we can work with you on building a retirement plan. Again, the number is 256-937-2010.
If you're pondering the longevity of your retirement savings with questions like, is my nest egg sufficient? Or how long will my retirement funds last? Consider scheduling a session with Chris Wallace. Text VISIT to 256-937-2010. Again, text VISIT to 256-937-2010 now to set up your appointment.
Chris, I do think you have some free stuff to give away. Free advice about retirement planning.
Well, I don't know that I'd call it free, Luann. We are a for-profit business.
Well,
but,
I know.
There's always nuggets of information in every meeting that we do, for sure.
Yeah, and now get this. This is what we're going to get into. We all are, we have the 401ks in our jobs, and a lot of us are, according to Vanguard, making a mistake with one simple mistake they say that more than 1 in 4 investors are doing, and that is leaving about a total of $170 billion each year in lost retirement wealth. The problem is that, well, I'm going to let you kind of explain that, but they're saying that people, who are leaving a job with a 401k are not putting that money back to work. So I'm excited to get in, talk about this mistake that so many investors are making.
Well, first of all, when you're talking about your 401k, there are a lot of people, and it's almost really sad if I think about it, with some of the people that we've met with, especially when you're in let's just say you're in your early 40s, and your time horizon's long at that point. For most people that are, say, 40 years old, I mean, you're probably minimum 20 years, probably 25 working, because at that point you maybe have teenagers and maybe you're getting ready for college expenses for kids and stuff like that. But for those individuals in their retirement plans to be using the stable value or cash account, it's very sad that they are, I guess, feared into that or scared into that by the news and the media. And so maybe you have a 401k and you're like, oh man, I don't want to lose money in a market crash. Meanwhile, you got 20 years to recover and the market always bounce back, et cetera, et cetera. But then you leave the job, and now all of a sudden you've left the job and you have this old 401k. I like to call them island 401ks. They're sitting out on the island. You really don't ever look at them. And before you left, you'd moved it more conservative, or maybe it's in a fund that, is not going to earn a lot of return over time. And then you don't roll it over. And again, now all of a sudden it's off. You forgot about it. And then you come back to it 10 years later. You're like, oh man, I forgot to move this thing. And oh, it hasn't earned anything. Yeah, well, that's because it's sitting in a cash account, not really earning a whole lot. And I think that when you leave a job, there's a couple of options that you have. There's a few options. Number one, the worst thing you can do, in my opinion, is cash it out if you're below the age of 59 and a half, because if you cash it out, you're going to get hit with a 10% withdrawal penalty plus income tax on that amount, depending on what bracket you're in. So that's like the least favorable option. The other option is to do just kind of like what we're talking about here, Lou, and you just leave it and you just hope it grows, and you're subject to whatever funds are in that 401k. The other option that you have is you could roll it to, from your old 401k where you're leaving and put it in your new 401k. That's an option that people have to do. The downside to some 401k plans, not all of them, but some of them for sure, is the limited availability of funds. So many of you listening to the show today you know exactly what I'm talking about. Let's take, for an example, TSP. It really has like 5 funds, the C, the S, the I, the G, and the F. And those are the 5 funds that you have, and you're going to pick from those. And some other 401ks may have a whole bunch of target date funds or life cycle funds. They're called different names. But at the end of the day, the funds I'm referring to are the ones with the years at the end. So the 2030s, the 35s, the 2040s. So you have a whole bunch of those, and then you have a few other little funds to pick from. So the funds within a 401k plan can be pretty limited. So if you roll it over, you need to understand, okay, this is what I'm going to go with, and this is what I have to select from. The other option is to roll it over into an IRA. And there are benefits there. And, if you're working with an advisor, most advisors are going to charge to manage that. But can that advisor maybe outperform you is kind of one of the things I would look at. If you're a real handsy investor, I like to say investments can be like a bar of soap. The more you handle them, the smaller they can get if you're not careful. I'm guilty of that myself. Sometimes I think I know what's going to happen. That's why I pay to have my funds managed as well. Some people say, well, that's weird. You're an advisor. Why do you do that? Well, I don't want to put my hands on it. And if I do, I'm likely to mess up and maybe sit in cash too much, which I've done in the past. So there are advantages and disadvantages to rolling IRAs over. You have to look at the fees. They're involved. There shouldn't be any fees to roll it over, but you may have some fees inside a fund. So you want to make sure if you're rolling that to an IRA, you're using low-cost exchange-traded funds. That's what we're advocates for. You want to make sure to keep your expense levels pretty low. And then, having that money out there in an IRA, if you were the larger custodian, you're likely going to have some, more choices. You're going to have larger choices, more funds to pick from than you would in a 401k. So that's kind of what I think Vanguard's referring to here in terms of, just leaving a 401k out there, not really doing anything with it.
Right. Yeah. So true. So how costly then would you say this error is to investors?
Well, it just depends, actually, Luann. I don't know. It just depends on how you're invested. I mean, shoot, if you're in a cash fund, like a stable value, because you're worried, you're 40, for example, like I was using 40, or maybe just call it 50, and you're in a cash account and you leave and the market jumps up, I don't know, 200% over the next 10 years. And that cash fund may earn 2 or 3 per year. And you could have earned, much more than that. That's your opportunity loss because you left it and didn't do anything with it. And some people are just, I'm hard-headed, Luann, about certain things. I'm not going to lie. Jen will tell you, like, man, why are you so hard-headed? Sometimes I think that just investors in general, I don't want to pay somebody. I don't want to work with somebody. So I'll just leave it, not pay anybody. Meanwhile, there's potential opportunity cost there or loss there. So I don't know. I think it can be more than 1% to 2% in some cases, Luann, maybe 3, 4. It just depends on how you left it. And, you could have put it to work in a different way.
Now, the question is, do you think people make this mistake because they just don't understand? Do you think that's the most people who make that mistake?
Yeah, there's a lot. There's probably a lot to unpack here when you say they don't understand. I think that when I look at and I'm sitting here as I'm talking, trying to picture, people that I've sat in front of throughout the years, and let's just take right now. People are worried about the election. People are very worried and very concerned about the election on both sides of the fence.
Mm-hmm.
They're worried about, who's going to be in office. And I think sometimes, Luann, some of it has to do politically, right? They think that so-and-so is going to get in office. And if that happens, I don't want to lose any money. Meanwhile, if you look at history, Democrats and Republicans, they've been cycling in and out of office for a number of years at this point. So just go pull the charts. And when you look at the market, it always comes through that okay. And there's very little differential over time, Democrats versus Republican. If you just left your money in the market, there's very little difference over time. And you may say, well, Republicans, you make more when Republicans are in office or when Democrats in office. But that may be true, but you make a heck of a lot more if you just left it alone and not put it in cash. So I think there's political motivation behind some of it, Lou, and some of it's fear. Mm-hmm. I think people are just afraid.
Yes.
And I call it the box turtle. You ever seen one of those box turtles that cross the road?
Yeah.
I'm a big turtle guy. I used to collect them when I was younger.
Oh, yeah?
I love them.
Oh.
I think they're just a cool little creature. And a box turtle, when you first pick it up, it'll withdraw in the shell.
Head goes in. Yeah.
Yeah. The whole body goes in.
Mm-hmm.
They'll draw up and their whole body goes inside that shell. And I think that sometimes investors have a tendency to do that. And they're just like, I'm going to sit, in that cash position. But then if you watch that box turtle, if you've held one of these before, it's not going to come out of the shell while you're holding it. Mm-hmm. But if you set it down, the box turtle will start to creak the shell open a little bit, and it'll start to peek its face out a little bit. You can see its eyes, and it'll take a long time to come out of the shell because it doesn't trust the surroundings.
No.
All right. Now, once you've had one of these as a pet, they don't ever go in their shell. You can feed them out of your hand like I used to do. But in this analogy, you've got that box turtle coming, and sometimes it'll take a little bit for the box turtle to come out of the shell. So when you draw up in your shell, i.e. when you go to cash, it sometimes is like the box turtle coming back out of the shell. Mm-hmm. You don't come back out fast enough because you're afraid. In other words, you went to cash, the market dropped. Maybe you saved yourself a few % on the drop, but you missed a lot of the bounce back.
Right.
And had you just stayed in because you're not using the money now, you would have been a lot better off. Mm-hmm. And so I think that social media does a disservice to people as well, Luann, and I guess instilling that fear in people. There are so many people out there saying so much stuff right now. It's like information overload. And here I am on the radio just saying, build your plan, stay invested. Like, have a plan and build your plan so that it will allow you to enjoy your retirement. That's primarily what we do at the office, some retiree work. Build your plan so that it will allow you to stay invested and not worry about the day to day. And if you're not using that money and you have a long time horizon, it really needs to be invested, probably a little bit more aggressive, because we know over time the market goes up and there's larger returns over time. That's what history has shown us. Well, yeah, Chris, but it's different now. No, it's really not. It's really not. I mean, you think about Great Depression, World War I, II, Black Friday, or I think it was Black Monday.
Yeah.
Gulfwar.com. I mean, there's always going to be something. And how you feel in that moment is why you think it's like the worst thing ever. Like right now, for those that are worried about the election, you feel like the U.S. is, it's coming to an end. The dollar's going away. They've been saying that stuff for years.
Yeah.
But it feels different right now. And I go back to what I've always said on the show is it's all in your face. Like you've got your phone in your face or your iPad in your face or the news on blasting, and that's all you're intaking. So it will rattle you. It will make you very, very emotional. And that's just because it's all in your face. And that's why it feels different. But if you look back, I guarantee you that if you were able to go back and talk to your grandparents, there were times that they felt like the U.S., this was it. This is it.
Mm-hmm.
Jesus is coming back. It's the end of the world, So there's a lot of reasons why people make these decisions, but fear is one of them. And I think it's exacerbated a lot by social media today.
So talk about ways then that you're helping people prevent these costly mistakes when it comes to their investing.
Well, first of all, it really does. And it's so cliche. And I know we talk about it on the show all the time, but it really goes back to the importance of having a plan. I can tell you and I've talked about this a number of times, when I leave the United States to travel, I don't like it. I really don't like it. Mm-hmm. We went to Italy over the summer. I was able to take my kids over there. And I'm going to tell you that if I had tried to go out and do some of the things on my own, I would have been a nervous wreck. But because we had a plan on how to get there, so we bought our tickets and all that, and we had this itinerary. Mm-hmm. And then we hired a couple of tour guides to do a couple things. We didn't do anything extravagant. But if I had tried to rent a car and go do all that myself, no, I'd have been freaking out.
Yeah.
No way. So having that, plan, or we had that plan in place, and this guide to help take us through certain parts of Italy, I didn't feel as, nervous or, out of place or whatever, because I had somebody there, guiding me. And I think that is important, especially when you're working on retirement or working towards retirement, that you have somebody that's walking that journey with you, that's done that with, over hundreds of people. And that's kind of like our firm. I mean, we have more than 250 households that we serve on a full planning capacity, here in the Huntsville area. And so having, us or that person beside you just helps relieve some of that stress. The other thing too, Luann, just to kind of help, as far as justifying or really helping avoid the costly errors, is building that plan. And then with that plan, it gives you the confidence to not make some of the decisions that you make. So when I see bad decisions being made, it's usually made when there's not enough information. Mm-hmm. Then that's when you do the whole box turtle thing and kind of draw up in your shell. And you're just like, hey, I'm just going to draw up in my shell and I'm not going to deal with it because I don't know what to do, because I watched YouTube and the YouTube person said this. And then I went to Facebook and the Facebook person said to do this. And then I went over to TikTok and that person was out of their mind, but it made sense because they shared some of the same values. So now all of a sudden I've got this bias going on. So really with us, it's about building that plan, giving you the real data to show you that the plan is going to last and how it's going to work and how you're going to take income and what your tax pictures are going to look like and where's the best place to pull income from. So you're not trying to figure all that out on your own or trying to YouTube yourself all the way through retirement in a time when you should be enjoying the time with your family. Like I can tell you if I'm on my phone at home and if I'm on it too much, I get the stink eye. You know what I'm talking about, right?
I do. Yeah.
Well, I can promise you if I'm on my phone in retirement, like some of the people listening to the show today, I will probably be divorced. Because Jen will want to spend time with me in retirement. She doesn't want to see me on my phone trying to figure out what's going to happen to the world. Mm-hmm. It's like live your life, put your faith in God. Oh, and I just said God, so they'll probably throw the religious disclaimer at the end of the show. I don't know if you knew they did that or not, Luann.
No, I did not know that.
Yeah, absolutely. Yeah. So, I had a lot of clients tell me. I already heard it because I listened to the whole show and I listened to all the disclaimers and disclosures. Anytime I mention faith or Jesus or God on here, I was like, oh, got to throw that disclosure on there. So anyway, have faith in God. Just have faith and, and just it'll work out how it's supposed to. Just know he has a plan. So anyway, that's kind of how we help out, Luann. It really starts with building out that plan.
Yeah. And I'm going to just throw this number. Nearly 70% of Americans are missing a written financial plan. So obviously, if you don't have a plan, you're going to be less confident. And we want you to be more confident and have clarity about your future. That's why we do this show.
Yeah.
That's why we give out your phone number, Chris, right?
Yes. Yeah. 256-937-2010. Call for that discovery session. That's a big number you just tossed out there, Luann. Yeah. 70% of Americans
don't have a plan.
Yeah.
And we're saying, get a plan, do it. Mm-hmm. We're offering it to you. Give him a call. Give Chris a call. It's complimentary. And the other thing you can do, we've made it very easy too, is just text the word visit to our number 256-937-2010 and get this complimentary discovery session with Chris. We would love to have you meet him in person if you haven't yet. He's just as more wonderful in person than over the air. I mean, just as friendly guy. You're going to.
Man, don't set these people up for failure like that, Luann. I'm crotchety.
You better be on your best behavior when they come in.
Oh,
no,
gosh.
Of course you will, but you always are. This is you. This is who you get right here. Chris Wallace of WG Financial Group. So
let's talk about that 70% for a second, Luann. Okay.
Yeah.
I mean, I'm just, we've talked about it before, but it just hit home a little harder today. It's like 70% of people are missing a written retirement plan.
3/4 of us. 3/4 of us. Yeah.
You're about to go and do something you've never done before, and you don't have a written plan. And now I know the engineers out there, and I still get it today. And I haven't poked fun at engineers a lot here lately, but I will today.
So today,
they're the spreadsheeters, and they're like, "Yeah, I got that spreadsheet." Luann, I kid you not. This guy brought in a spreadsheet the other day. Oh my gosh, it was like on this big, huge piece of paper. I told my advisor that sits in the meeting with me, I said, hey, listen, you're probably going to have to fold this thing down into like fourths.
Oh my goodness.
And take photographs of each page because our copier ain't going to copy that. I mean, he brought in this big map almost. And, it was a bunch of information on a spreadsheet. It was great. I'm poking fun, but it was great for him to bring that in. But yeah, I mean, a spreadsheet's great for certain things, but it's really hard to spreadsheet your retirement. Like, we were talking about taxes in the earlier first segment. And I don't know how, you're going to spreadsheet just all of that without it being this elaborate spreadsheet. And that just ain't me. I'm sorry. That's why I have a CPA. That's why I have an attorney I personally work with, and that's why I have my own investment. I don't want to worry about that kind of stuff. Here's what I want to know. I want to know what do I have to do to one day be able to fully retire? That's what I want to know. And I'm just speaking from the heart here. Like this is me. What are the markers that I need to hit? Okay. I need to max out my 401k the rest of the way. So does Jennifer. Catch up and everything. I need to max out my HSA because I have plans for my HSA in retirement. That's going to fund my health care and possibly some of my long-term care if I can grow it to be large enough. So those are some of the key markers that I have to hit. I need to make sure that I don't incur any debt. I'm currently debt-free except for my house. My house is at a 2.75 interest rate, so I'm not really in a hurry to pay that off because I'll probably never see that again in my lifetime. And the way I look at that is it's not free, but it's pretty doggone close, right? I mean, it's just not a lot of interest on the house. So eventually I'll pay it off. But I know that by the time I get to retirement, I do want to have it paid off. I'm just not in a hurry to do it today. So those are some of the key markers. Be debt free, max out my retirement plan. I know the number I need to get to. And if I have my house and I can sell it, and then, maybe Jennifer and I downsize, who knows? But those are the type things I want to know. I don't want to be trying to figure out which way the market's going in retirement. I want to have a plan that works in all kinds of markets. I want to know if the market drops 30%, which, by the way, is fairly rare. If you look back over history all the way back to 1928, the market has only been negative more than 20%, like 6.75% of the time. So there's not a high probability that happened. But what if it does? What if that happens in my retirement? I want to have a plan that will still work if that happens. If we have a great recession like 08, 09, 07, 08, 09, I want to make sure that my plan still works. I want to know that my plan still works if the market goes up. I mean, most everybody, if the market goes up, the plan's going to work great. I want to know what happens if it trends sideways for, I don't know, maybe a decade. Maybe we have what they call like the lost decade from 2000 through 2010, where the market was basically flat. I want to know that my plan's going to work in that environment. And if I know all of those things and I fund my retirement accounts properly, I have the right insurance, my legal documents are in place, I know how I'm going to take income, that's all I really care about. I don't want to be worrying about the day-to-day. I want the plan to work in all environments. And that's kind of where we really encourage people, Luann, is to get to that place in your retirement and your pre-retirement so that you have a plan to know that if this happens, I'm still good. If that happens, I'm good. If COLA on Social Security is smaller, I'm good. What if they cut Social Security by 25%? I want to still be good. Mm-hmm. And that's really where we help people.
Hey, real quick, let me give your phone number. Let me give your phone number out. I can't talk, but I want to get into the falling interest rates real quick. But 256-937-2010. Remember, call for a complimentary visit. Okay, so we're seeing these falling interest rates now, and so I want to get into as we're getting into retirement. Obviously, we want to live out our dreams, whatever that means. Okay, whatever we've been dreaming of. But this environment's different than the retirees have been experiencing. So talk about what are some things that people need to be considering right now to adapt to now this new environment of lower interest rates.
Well, for the last, since 2008, 9, we've been in a pretty low interest rate environment. And we just over the past couple of years, we've seen rates come up to where you can make a little bit on your savings. And we talked about the tax potential hits in those situations in the first segment there. But at this point, it looks like rates are kind of dropping a little bit again because inflation appears, and I'm kind of doing a little quotation here. Maybe it's under control. Maybe it's not. We'll see in the near future. So rates look like they're going back down again. So it does make it harder on the retiree, especially those who are in a position where they can't afford to take a big loss. So a few minutes ago, I said, I want to make sure that if the market drops, not me, but if the market drops 30%, I want to make sure however I'm invested, it's still good, that I'm still good. Mm-hmm. And I think when we're talking about these lower interest rate environments, a lot of retirees need to go a little bit more conservative. Not all of them. All right. So there's going to be people like, not me. I'm 100% stock. I'm good. I got 14 pensions. Yeah, you're good. You can have a long-term outlook. You're good. But I would say a large majority of retirees will want to be more conservative because it is really, instead of return on your money, it becomes return of your money in retirement. So you want to make sure that it's there for you and that you can generate income. So maybe you take a more conservative approach as you get towards retirement and then you go into retirement. But when rates are lower, that means the more conservative investments, they don't pay as much. And sometimes they'll struggle to keep up with inflation. So finding that right balance between, how much risk should I take or should I be taking to support my plan long term? And then how conservative can I be without being too conservative? Because believe it or not, Luann, there's a problem with being too conservative. There's an emotional problem with both. So when you retire and you turn off the proverbial faucet of income, as we like to call it, then you're like, oh my gosh, this is all I got, and I've saved, and I don't want to risk it because now I'm afraid of losing it. And so all of those are emotions. Even though the plan may say, hey, you're fine, like you can take more risk. The plan may say you're fine. Your risk capacity's there, but your emotions are like, I can't deal with it. I can't deal with it. Well, then when the market drops, you're like, now you're freaking out because the market drops. But it happens the same way on the other side too. You can be too conservative. And now all of a sudden you're not making the returns. And mind you, the market over history is up about 75% of the time. And about 73% of the time, 73% of that 75%, the market's actually positive double digits. So if you're too conservative, now all of a sudden you're missing out on some of the larger years. So this is why balance is really, really important. So now it's an emotional decision from that side, or emotional struggle from that side, because you're like, oh, I don't really want to lose money, but oh man, I'm really missing out. Then you get what I call FOMO, which is I don't know if that's a Gen Z or whoever created that term, but fear of everything's got an acronym today.
I know
fear of
it
missing
does.
out, right?
Yeah.
So now you got FOMO if you're too conservative, and now you got FOMO, and now you're not keeping up with inflation the way that you should because of these low interest rate environments. So I think it's important to find good balance in your retirement plan, one that will help the plan work and then help you sleep. So there's two things. Plan needs to work. You need to sleep. And those are two key things that I think most people need to focus on.
Chris, we are coming up on the end of our show, out of time.
Yeah, we are. So let's talk about discovery session for a second, because we mentioned that it's a pretty simple meeting that we put together where I go into a lot of detail. It's a great opportunity for us to connect, for you to learn more about the firm. It's a great opportunity for me to learn more about your family and where you're trying to go. And what we do in those meetings is usually takes about an hour and 15 minutes. And, usually people have a lot of questions. I really try to answer most of those questions if I can. At the end of that meeting, we'll decide whether or not we need to come back in for what we call a high-level strategy session. But make no mistake about it. When people come into the office, number one, it's confidential. We don't share the information with anybody else. The other thing that we don't do in that meeting is we don't make any financial decisions in that first meeting. It is literally an opportunity for us to sit down together and go over your entire situation, where you're trying to go. It's an opportunity for me to see if I can add value to you or your family. So if you'd like to set that up, you can call 256-937-2010. I almost forgot the number, Luann, 256-937-2010. You'll call in, leave a message. Hey, listen, we have a call center. They do call center things. Sometimes they hang up on people. Sometimes they're not as nice. Please understand, that's not my staff. It is a call center. But we like for people to call in, talk to that live person, leave your information, and then you'll get a call back from my wife, Jen, that following Monday when we get back in the office. So, Luann, it's been a great show. Hope everybody has an awesome and blessed week. And remember to serve every person in every situation with a servant heart.
It is important for investors to understand that dividends are paid at the discretion of the board of directors and are therefore not guaranteed. AE Wealth Management, LLC provides services without regard to religious affiliation, and the views of individual advisors are not necessarily the views of AE Wealth Management.
Investment advisory products and services made available through AE Wealth Management, LLC, a registered investment advisor. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. AEWM does not offer insurance products. Insurance products offered by WG Insurance Services are not subject to investment advisor requirements. AEWM and WG Insurance Services are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. WG Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial Group. This radio show is a paid placement.